Welcome to the Deep Dive. We aim to cut through all that noise and give you the insights you really need to feel truly well-informed.
Exactly.
So here we are, midway through 2025. And if you've been keeping an eye on the markets, you'll know the S&P 500 index. It's up a pretty solid 5.5%. Even hit a fresh all-time high not long ago. Sounds great, right? Everything's looking up.
On the surface, yeah.
But for those of us, who like to dig a bit deeper, when you see those kinds of headlines, what's the first sort of but that jumps into your head?
Well, the immediate thought is always about what's not quite in the headline, or maybe what's being overshadowed.
Right.
Because even when the broad market is doing well, like now there are often these underlying uncertainty. Things like tariffs, trade policies, maybe stuff that can create pockets of, let's say, turbulence, even if the overall picture looks calm.
Absolutely. And that's exactly where we want to take you today. Our mission for this deep dive is really to explore a slightly different angle on the market. We're looking at what some people call contrarian buys.
Right, the ones going against the grain.
Exactly. These are stocks that, despite the market generally climbing, they've actually had a pretty rough first half of the year.
A really rough half for some.
Yeah. And the thinking is maybe their fall has been, maybe it's been overdone.
Overreaction, perhaps.
Creating a potential opportunity, right?
Yeah.
For them to maybe outperform the S&P 500 in the second half.
Yeah.
So how do we even spot an overdone fall? Is it just about a big percentage drop, or are there specific things we should look for beyond that sort of initial market panic?
That's the crucial part, isn't it? For a real contrarian play, you're not just looking for a stock that's down. Anyone can find those.
Sure.
We're looking for a disconnect, a kind of gap where the market's perception, which might be driven by fear or just short-term noise, doesn't really line up with the underlying business reality.
Right.
It's almost like the market is pricing the stock for this absolute worst-case scenario, that the company, even with its challenges, isn't actually facing that big gap between how the market sees it and what the fundamentals say.
Yeah.
That's where the contrarian opportunity really sits.
Got it. And to make this really concrete for you listening, we're going to unpack three specific companies today: UnitedHealth, Marvell Technology, and Decker's Outdoor. We'll dig into their recent struggles, but also why at least one analyst thinks their potential turnarounds are key to understanding these more nuanced market opportunities. Let's get into it.
Sounds good.
All right, let's kick things off with a company that might surprise some people on a contrarian buy list: UnitedHealth. Ticker UNH.
Yeah, a giant.
A giant. And as of the end of June, shares were down. Get this, 38%.
Oof. That's a massive drop for a company that size.
It really is. I mean, think about it. This is a company that once had a market cap way over $500 billion. Now it's sitting around, $275 billion.
Quite the haircut.
So when you see a company of that scale take such a steep dive, it makes you wonder, naturally, are we sure this isn't a sign of, deeper systemic problems, not just overdone selling? What's the strongest case against that really bearish view?
That's a really fair question, and you have to ask it. On the surface, a 38% drop looks pretty dire.
Right.
And look, there are genuine risks with UnitedHealth. We can't ignore them. There's ongoing talk about healthcare reform, potential government spending cuts, and always that challenge of rising medical costs. Yeah. Those are real headwinds.
Okay.
But if we look at the analysts' thinking here, they point to a few key things that suggest the market might be misjudging the longer-term picture, the resilience.
Like what specifically?
Well, what really stands out is valuation. UnitedHealth shares are now trading at just 13 times trailing earnings.
13, wow. Compare that to the S&P 500 average.
Which is around 24 times. So a huge difference.
Right.
That dramatic split in valuation, it kind of suggests the price might just be too low to ignore. Almost like you said, all the potential bad news is already factored in, priced in.
And wasn't there some news about guidance and leadership changes too?
Yes, exactly. The company did withdraw its guidance for the year, citing those rising costs. And the former CEO, Andrew Whitty, he stepped down. But the new CEO, Stephen Hemsley, is still aiming to get back towards their long-run target, something like 13% to 16% growth.
Okay, so there's still a growth narrative, even with the changes.
There is. And given how low market expectations seem to be right now, UnitedHealth could actually be in a pretty decent spot to maybe deliver a positive earnings surprise later this year.
Ah, the low bar effect.
Kind of. Any sign of progress, really, any little hint that the business is stabilizing could potentially lift the stock. Investors are always looking for signs that things are on the right track, even if there's still some risk involved.
Okay. Interesting case there. Let's pivot now sharply into the tech world. Our next contrarian idea is Marvell Technology, ticker MRVL. Custom chip maker. Big name in high-performance stuff, especially, AI.
Very much so. Key player.
But even with AI absolutely booming, Marvell's had a tough first half, too. Down about 30% at the midway point of the year.
Yeah, another significant pullback.
So what happened there, given, the seemingly endless demand for AI infrastructure?
Well, the immediate trigger for investors came earlier this year, Marvell's guidance. It just wasn't quite as strong as the market was hoping for, maybe expecting even.
Expectations game again.
It often is in tech, but what's really crucial to understand about Marvell is their position in ASICs.
ASICs, remind us.
Application-specific integrated circuits. Basically custom-built chips designed for very specific high-intensity tasks. And they're becoming absolutely essential, like the core plumbing for AI infrastructure in data centers. Think big players like Google, Amazon. They rely on this kind of custom silicon.
Gotcha. So the underlying need is still massive.
Exactly. So while Marvell's near-term outlook might have spooked some investors,
right,
the fundamental demand for these very specialized AI chips, that's not going anywhere. If anything, it's growing.
So the argument is the market overreacted to the guidance.
That seems to be the analyst's view, and it makes their current valuation. They're trading at a forward price-to-earnings multiple of about 27. Looks surprisingly reasonable.
27 times forward earnings for a key AI player.
Yeah, especially when you compare it to Marvell's own historical average or just the massive growth potential in the AI sector it serves. It looks, well, attractive.
So again, it's about finding that disconnect where the market might be punishing a company too harshly for short-term noise and maybe missing the stronger underlying signals.
That's the idea.
Because looking at their actual numbers, Marvell reported, $1.9 billion in revenue in its last quarter, the one ending May 3rd.
That's right.
And that was up 63% year over year. That's huge growth.
It's very impressive growth.
Exactly. This is still a business firing on a lot of cylinders with significant growth potential, both near-term and long-term.
Right.
With AI spending just showing no signs of slowing down, the analyst view is, basically, don't be surprised if Marvell posts some better-than-expected results in the back half of the year.
So it could be one of the more attractively priced ways to play the AI boom right now.
Potentially, yes. If you believe in that long-term AI story, Marvell looks like an interesting name at this valuation.
Okay. One more to cover. Let's wrap up with Deckers Outdoor, ticker DEFI.
The Hoka and UGG folks.
The very same. And their shares were down. This one's really stark, down a staggering 49% through the first 6 months of 2025.
Nearly cut in half. Wow.
You hear that, and you immediately think, okay, heavy exposure to China maybe, tariff risks, potential for consumers to pull back on discretionary spending if the economy gets rocky.
All valid concerns.
It sounds like, perfect storm brewing, doesn't it? It really does. On paper, it looks bad,
right.
But then you peel back that initial reaction, that fear, and you actually look at their sales figures.
Yeah.
Exactly. This looks like a classic case of perception versus reality. The market seems to be pricing in the absolute worst, like everyone's just going to stop buying Hoka running shoes and UGG boots tomorrow.
But they're not.
Well, their most recent results, the ones that went through the end of March, they tell a completely different story, a remarkably different story, actually.
What did they show?
The company's quarterly sales topped $1 billion, over $1 billion.
Okay.
And they were up 6% year over year, sales up, and net income. That rose 19% to $151 million.
So sales up 6%, income up 19%, while the stock is down nearly 50%.
Precisely. The fear just seems to have totally overwhelmed investors here, pricing in this sort of doomsday scenario that just isn't actually happening in the company's financials.
So despite all that negativity swirling around, the actual business itself is, well, it's still growing.
It is still growing.
And what does that valuation look like now? Trading at about 17 times trailing earnings, you said.
Yeah.
What does that really tell us for a company that's still posting that kind of growth?
For a company still growing at a pretty decent clip, 17 times trailing earnings looks incredibly attractive as a multiple.
Right.
If we connect this back to the bigger theme, with so much negativity, so much bearishness seemingly already baked into that stock price.
Yeah.
The analyst thinks, don't be shocked if the stock manages to outperform the S&P 500 in the second half and potentially over the long term, too.
Especially given that low valuation relative to its actual growth.
Exactly. It's almost like the market's throwing the baby out with the bathwater here.
Yep.
Predicting the end of demand for comfortable shoes, even while Decker's own numbers say otherwise.
Okay, so let's try bring this all together. We've looked at 3 very different companies, UnitedHealth, Marvell, Deckers. What's the big takeaway from these contrarian examples for you, the listener?
Well, they've all had these tough first half declines, right? 38%, 30%, and that huge 49% for Deckers.
Yeah.
But each one presents this kind of unique case for why a rebound might be possible.
It really comes down to perspective, doesn't it?
I think so. The power of perspective here is really about understanding why a stock has fallen so hard, and then doing the work to assess if that fall is, overdone when you compare it to the company's underlying fundamentals.
Right. We saw that with UnitedHealth's surprisingly low PE ratio, Marvell's core strength in those custom AI chips, even with the cautious guidance.
Yep.
And Decker's steady sales and income growth, even with all those market headwinds people worry about.
Each one has a specific reason, grounded in fundamentals or valuation, why the negative sentiment might be overblown.
So what really stands out to you from this deep dive, when we invite you, the listener, to consider that maybe true insight isn't always found in what's popular or performing well right now.
Good point.
Sometimes it's hidden in that nuanced understanding of value where maybe other people only see risk.
It forces you to think differently.
Yeah. Think about how much of a company's bad news might already be priced in by the market. Does that create opportunities for people willing to look past the immediate headlines?
It's a great question to ponder.
It really raises an important question for you. How often do those initial, sometimes panicked market reactions truly reflect a company's actual long-term potential? And maybe more importantly, what are you missing by only looking at the biggest, loudest headlines?
Something definitely worth thinking about.